Hello, everyone. I'm Andrew McDonald. I'm actually here with my good friend, Fernando. Fernando, can you please introduce yourself to everybody who's watching? Share something about yourself, where you're from, and what you do.
Yeah, absolutely. Thanks for having me, Andrew. Fernando Angelucci. I'm the CEO of Self-Storage Syndicated Equities. We've done a little over $200 million worth of storage in the last 5 years, primarily through capital raising efforts on the 506c side. I am from Chicago, but I've been traveling the world for the last year. Spent 6-7 months in South America. I spent another 4 months in Europe. I'm here for a little bit to do a couple closings, and then I will go down to Mexico next. In a nutshell, that's us. We kind of have three main strategies. We buy existing properties, self-storage facilities for mom and pop operators, and we aggregate them into portfolios. We also build ground up Class A REIT grade facilities, and then we do adaptive reuse conversions of old big box retail stores into, Class A storage. So that's a little sneak peek on us.
That's fantastic, man. I've been wanting to interview you for months and months and months, so I'm happy we finally got together, because I know you were jet setting, I was jet setting, so for us to get together, it's great.
Right.
Yeah, and I just want to congratulate you. You sold a huge part of your portfolio recently, and so I will call you the $100 million man. So, can you share with the audience, like why you liquidated some of your portfolio, and what your thoughts are on the market for self-storage, and your thoughts, let's say, in the next few years?
Yeah, absolutely. So, as everyone saw, 18 months ago or so, the Fed signaling that they were going to start raising rates. So this, 10-year period of easy money and near zero or 0% interest rates was coming to an end. So I figured, okay, this would be a good time to get rid of any of the assets in my portfolio that I don't want to keep through the next, 7 to 10-year market cycle. So we sold off 12 of our facilities at a really good cap rate to 10 in one go to a operator, a private equity fund out of New York, and then 2 of them as off to the side sales individually. And that allowed us to free up a lot of capital to start diversifying, out of storage. We really like storage, but it doesn't, you should never have all of your eggs in one basket. So that freed up a lot of capital for us to diversify into other asset classes, other sponsors, things like that.
That's great, man. So I like how you mentioned that, because that's how we met, right? You got interested in what I was doing, and we are like-minded. We're both, have a libertarian background. We both, are self-employed and self-made, that kind of thing. So you saw, with our initial call, I didn't really need to explain anything to you, because you already got all the main things. You were up to speed with economics. You're up to speed with the Fed. You're up to speed with the dollar. You probably, like physical metals, like you already understood all that. What you weren't up to speed on was really just the individual mining companies and the mining industry as a whole. And so I basically explained from scratch, like in an hour or two call with you, why I was investing in it, why you should have invested in it. And so basically everything made sense to you with that call, right?
Yeah, exactly. So I love to study macroeconomics, especially from a geopolitical standpoint. The U.S. has been exporting their inflation for quite some time, but there's only so much these other countries are willing to put up with. And we're already starting to see these, BRICS plus and, G77 meetings where there's this push to, try to make headways into establishing a competing global reserve currency or basket of currencies. And so I figured you saw how much money not only the US but almost every country in the world has printed in the last call it 10 years. That's eventually going to catch up with you and devalue the majority of your investments, and especially a dollar, right? So with that, I wanted to put some eggs into a basket that would hedge against that deflationary aspect on the currency, inflationary aspect on, other asset classes, and see where there is the ability to make some asymmetric risk return based on what we've seen in, specifically talking about what we've been talking about, the commodity cycles. We've been in a pretty low bear market for commodities for quite some time. And with the push by the G20 to electrify the world, if you will, to cut down on greenhouse gases and this climate change, situation that's going on, they're really pushing for a lot of electrified vehicles, replacement renewable energies like solar and wind, and those things require quite a bit of rare earths and precious metals to work and to function. And based on the demand that we're seeing that's needed to get to the goals set by the leading countries, the 2030 and 2050 goals, there's just not enough of these rare earths and precious metals to go around. So I think there is a potential for that to be a great hedge as that initiative keeps getting pushed forward.
Yeah, it's a great point you made. The West is is pushing all this green energy and net zero kind of bullshit, and the thing about it is, if you actually look at it, the BRIC nations and mostly Asian countries, 80% of all gold purchases are actually coming from them. Only 20% of gold purchases is coming from the Western nations. Mm-hmm. So if you think about it, what side do you want to be on? Do you want to be on the side where the people are buying they're accumulating like crazy, or do you want to be on the side of governments that are spending and printing money like crazy and not really doing anything? Trudeau sold all of Canada's gold reserves. Do you think that's a smart move to make? I don't think so. And like you'd mentioned, the electric cars and all the green initiatives like solar panels and windmills and all these things, that they require so much. One statistic is all the copper in human history has to be mined in the next 20 years. So it's like, it's insane amount of copper, and it's just not going to happen. Number one, the politicians are holding up all the permits. It takes on average for a copper project at least 15-20 years. There's one copper project that's took 40 years and still not in production yet. And that's just to give you an idea of these kind of environmentalists. They want these green energy the projects, but they don't want to do the mining. And you can't have that. You need to have it. And so, Fernando, you're smart. You recognize that we don't have these materials. We have a lack of supply, and we have a growing demand. And if you know anything about basic economics, people watching, that if supply goes down and demand increases, the price has to rise. Now, right now we're in the worst commodities market in 40 years. And so, Fernando, I know you are able to spot when something is when there's an opportunity. You're a value investor. That's kind of why you sold some of your portfolio, right? Because you saw that the herd is wanting to buy, and you're like, okay, I'm going to exit, and cash in my chips. Not that you're exiting self-storage completely. You're just waiting for the next opportunities to arise. And so that's a smart thing to do. I encourage everybody to take gains when they can, because in a heartbeat, when there's a downturn, all those gains can be evaporated, right? And so the call that we had really was just me explaining that this period of time, all the stars have aligned when it comes to mining companies and exploration companies. There's such a lack of investment, and it's been that way for at least a decade now.
Mhm.
Since the last bull market that ended in 2011, that the market is this commodities market has been beat up so badly that the risk to reward for you, Fernando, and anybody that's watching, is so in favor of commodities versus any other asset class right now. So, like, you were able to recognize that and pull the trigger on it, like it, you already knew all the stuff. You just once you heard about the like for copper and uranium and gold and silver, the kind of deficits they have, and um in our group, I'm always posting charts like to show the levels of all these metals. And one of the recent charts that I posted to everybody was just how low the copper supply is. We have, like, I think it depends on the demand, but like 5 to 10 years of copper, and the supply might take 20 or 30 years to come online. It's insane, and so
Well, not only that, but if you also look at this trend towards deglobalization and friendshoring and onshoring. So, you have the base materials themselves, copper and these other mined rare earths, but you also got to realize that there's supply chains that also feed into that, the machinery that's needed to do these mines. That in and of itself has its own sets of supply chains to make the machinery. Who gets the base materials to make that machinery? And I see all of that causing a serious issue over the next, call it 10 to 40 years, where it's just another base case for why having exposure to the mining industry, companies that already have production with the ability for upside to get acquired by larger conglomerates. I just see, in the end of the day, when you need the material quickly and prices are skyrocketing, it may not make sense to wait 10, 20, 30 years to put up your own mine. So what are you going to do? You're going to go out and you're going to acquire those that already have proven deposits.
that's right. And you want to the companies. There's different levels of readiness towards being a mine, because from scratch to operating mine can take 10 to 15 to 20 years.
Right.
And like you were mentioning, the actual processing of these raw materials, right? So for example, in Russia, they process 40% of all the lithium in the world. And so we don't have a lithium, like there's an abundance of lithium around the world. It's just that there's not enough online processing ready to go. And the United States outsourced all the processing to China and Russia. And so they are way ahead of the game. They've already made those investments in the machinery, the equipment, the plants, the processing, everything. Whereas the United States is now having to it needs another probably 10 to 20 years to catch up. But in the meantime, the U.S. is in financial jeopardy because of the rampant spending. The U.S. just crossed 33 trillion in debt today. It's insane. It's almost like $1 trillion a month now being added to the national debt. At some point, it'll be 40 trillion, and then The interest on the debt will just make it unsustainable. And I think what's happening is you'll see that the U.S. Treasuries, there will not be any demand for U.S. Treasuries, which will then push up the cost of debt. Interest rates will rise, even if the Fed does try to intervene, because QE has an effect. It's a less and less and less effect. So if you shoot the patient full of morphine the first time, it works kind of. Then the second time, it takes more morphine, and then the third time, and more morphine. It's only so much
diminishing returns.
Body it's only so much the organism can handle before it just doesn't work. And so there's going to be a situation, man, where the treasuries, China is already letting their treasuries mature. Instead of reinvesting them back into new treasuries, they're buying gold with it. And so for a long time now, China has been hiding what their true gold holdings are. And so it's really just, for me, I think that once China finally reveals what they've got, like they show their cards, going to just fold, like everybody's going to lose. Like China and Russia, the BRIC nations, it will be such advantage against the United States that now, not to say that the United States is down and out. I think, if you think about back in history, after World War II, Germany was destroyed after World War II, and it took a full generation for it to get back on its feet and to rebuild and to become the nation it is today, even though it's going in the wrong direction. At some point, they were the biggest manufacturing country in Europe. And I think that's going to happen in the United States. It's going to take a full generation for the U.S. to reestablish itself and to get back on track. But in the meantime, the entire world's financial system is going to change forever. And what worked for the past decade isn't going to work for the next decade.
Yeah. I think there's some interesting counterpoints out there as well. I keep coming back to this concept of deglobalization. There was a book that I read recently that I really liked that kind of spelled this out. It is written by Peter Zahan. It's called "The End of the World is Just Beginning," and I think there's some really interesting parts in there that you can give the Western Hemisphere a lot of credit for the way that they're set up, specifically the United States, with its ability to be insulated. So after you talked about World War II, after World War II, the United States basically set up this global order, big O, that basically said, hey, our Navy ships, our merchant Navy ships, basically will protect all global trade. But once, that was in exchange for exporting our inflation and selling our treasuries. Once you start to see a substantial reduction in treasury purchases by foreign nations, especially in the Eastern Hemisphere, I think there's going to be a pullback of that, that Navy protecting all of the trade routes across the world to allow for, just-in-time supply chains and globalization to really work. And that's going to cause a lot of problems around the world. But I think the United States is pretty well insulated. It's not that they're going to get off scot-free, but I think they're going to be set up to handle what's coming a little bit better than other countries. So, I think there's a lot of interesting points here to look. And the key is it's going to come back down to the ability to source materials. And when you look at the Americas in general, so North and South America, you have a lot of supply of these materials. The issue is, like you said, a lot of these rare earths and precious metals, they are processed not in the Americas because of the disparity in labor cost and then also how finance has been used. So, for example, China does a lot of processing for a majority of their rare earths. So does Russia, and that came through the ability to hyper finance projects where basically they were the only ones that could do it at a global scale that made sense. It's going to take, like you said, 20 to 30 years for that processing capacity to be brought back into the United States, all the way from base materials all the way up to high value add materials like semiconductors and chips as well. But we're starting to see those efforts be put into place of this onshoring or this friendshoring, as they call it, to start bringing some of that capacity back in-house as opposed to exporting it out and then receiving finished goods on the back end. Because like you said, as these countries lose faith in the treasuries or the ability to pay back debt, it's going to be much harder to manage these types of trade deals. As we've seen over the last 6 years, we've had some pretty hardcore trade wars, if you will, with a lot of manufacturing powers in the in the world. So it's very interesting points that you're bringing up here, and I think one of the ways to not really, the word take advantage is not the correct word, but a way to hedge against kind of the downsides of these effects are to get exposure to these type of mining companies, especially the ones in the Americas. Canada, US, Mexico, even northern parts of South America as well. Brazil is extremely mineral rich country. Their processing capacity is not where it needs to be to take advantage of all that. But if they can set up trade lines with, say, Mexico, I think is going to be one of the greatest processing locations in the Americas coming over the next generation or so, because of the cost of labor in relation to its neighbors, and then some countries as well in the northern parts of South America. So I think all of these kind of these points bring us to the conclusion of why it's important to diversify, especially into this, these commodities sides of the world, these precious metals and rare earths.
That's great, man. That's a lot to unpack right there. First off, what I'll say is the U.S. has everything it needs within the continental U.S. It has all the materials. It has uranium, gold, silver, rare earths, copper, everything in abundance. Oil, gas. They do not need anything. They do not need to import anything. They are so rich in materials. The problem is it's the anti-mining and the environmentalists that are preventing the United States from extracting all those resources that are badly needed. Like, for example, in Alaska, during the Trump administration, there was a project in Alaska that the governor, the people wanted, and all of a sudden, Trump's son said that he goes fishing next to that project, and he didn't want it to be approved, and so they declined that permit based off of Trump's son saying that he wants to go fishing there, so they declined that project. So just to get an idea, it's that battle. It's kind of like back and forth. The world needs stuff, but there's this resistance against it. The other problem within the U.S. is not just the having to build this. It's actually the manpower and the experience and the knowledge of how to do all this stuff, how to process. Now, the good thing is Canada has a lot of mining people and a lot of mining experience, processing experience. So, but those people will be in such high demand that it's going to take, like I said, it's going to take at least 10, 20 years to build the manpower and the brain power and the experience to bring that to have that come through with the United States. It's not going to be quick. It's not going to be cheap, but it will happen. The market always works. When things are badly needed, that's when opportunity arises, and that's when the market fills that need. The good thing I would say is that I believe that the U.S. has to default at some point. It has to technically default, even though it would be drastic. It's the best option out of the other option, which is just to print money to forever and to end up eventually being the Weimar Republic, which then the rest of the world forces the United States into stopping spending. You mentioned one other important thing about the Navy. When the interest on the debt is higher than everything combined, Social Security, defense, healthcare, all the welfare programs, once interest is high enough, the amount of taxation coming through will not be able to pay for these programs. And so the Fed is either going to have to decide to print money to pay for those, to maintain the military, or the government is going to be forced to cut spending. And actually, the Fed has the right to tell the government, no, we're not going to fund this anymore. It's just that the Fed is political, and they basically don't want to tell the government no, because then Jerome Powell would get fired and he would get replaced with another puppet. So basically, they're not. The Fed is not independent. They are basically told what to do by the president and the government in power. But when there's no navy to, like you said, to export the inflation away and to pressure other countries to be scared to fall in line, otherwise you'll get sanctions or we'll go to war with you. Once that threat is gone, then the dollar has nothing really left. I mean, I, there's people like, I don't believe the U.S. has the gold reserves that it says it does. I think it's all sold or used as collateral. I think that if there's a real audit on the true reserves, it's much, much, much less than what is stated. So I think compared to the entire world stage, I had an argument with somebody about China being worse off than the United States. The problem is China just had millions of people lifted out of poverty, and they are now wanting to be an import nation versus an export nation. Even though there is tons of government debt by China, I think they'll be able to with the amount of gold that they will have, I think they'll rebalance their entire system, and that will change if there ever is a BRICS currency that comes down the line. I think eventually that will reset the entire financial system. And so it really doesn't matter how much debt China has. It really just matters what they're doing with the cash flow that they bring in from the importation of dollars.
Yeah, that's an interesting point. The counterpoint that you were just talking about, as far as the bull case for China, Ray Dalio has written about that quite a bit. Again, I think one of the issues here is kind of this deglobalization, and then underlying cause of this is population growth and replacement growth. So if you look at the Chinese economy, and yes, it wants to become an import nation, but you got to see that their birth rates are falling substantially. A lot of first world countries' birth rates are collapsing right now. So if all of a sudden you don't have the workforce to supply the means of production, and then therefore reap the economic benefits of such, that causes massive issues for economies that are on rapid growth trajectories like China. I mean, they had the one-child policy for the longest time, and then went to a two-child policy. So not only did that decrease the the birth rate, but then it also caused a massive imbalance in the genders. So now you have a lot of males that aren't creating households because they either don't have the availability or the or even the economic means for household creation. And as you know, typically, like the United States, which is a consumer-driven economy, something like 70-something% of our economy is based on consumer goods. If you don't have that household formation, which is one of those main drivers of that economic powerhouse, it makes it very difficult to become an import nation when you don't have money to spend because you don't have work. You don't have the people to do the work to make the money to spend, right?
No, I totally understand that. And really, it's going to be interesting over the next couple decades. You're going to see that there's going to be deflation in a lot of different parts of the world. There's going to be, but here's the interesting point, and I need to make this point, is that some of the deflation will not affect certain different prices. There will be sticky inflation even with deflation in asset prices and risk assets mostly. There is going to be reflation through QE, and so I don't think that we'll end up with a scenario where, because of declining birth rates, we'll have massive deflation. I think that will trigger fear from governments around the world to stimulate, because if you think about it, communists and left-leaning governments around the world are they believe in MMT, modern monetary theory. So yeah, man. So look, we could talk about this for hours. Man, just share with everybody why, when we had our initial conversation, what made you pick working with me, man?
Yeah, so I really liked your research. A lot of the papers that you're pointing to made a bunch of sense. I'm an engineer by training, so it is just a bucket that I really wanted to diversify into with some of the available funds from that previous portfolio sale. And once I started asking around and doing research, I came across your profile, and I really liked what you were saying. I know you have kind of two groups. You have a group that anybody can join, and then you have kind of like a mastermind group, which is a level above that. So I hung out in the kind of free to join group for a while. I saw the quality of the research, and then it also helped me point me in the direction that I needed to go to find the research that I was looking for. So that's, I say, the reason why I decided to work with you, just because it helped out quite a bit. Obviously, I'm a pretty busy guy with the companies that we run, so it's good to have somebody that spends the majority of their time on this, and then allows me to just fact check and do supplemental research as opposed to the main body of the research myself.
That's fantastic. And so you like, and so the data that I provide helps you make decisions, and you're able to then take that data and have the gut check with it, and then the sniff test, and it's passed all these things with you.
Right. Yeah.
That's great. So tell me, man, and just wrapping up this conversation, what is the coolest thing that you've heard from me that you think that has helped you the most in your decision making, or in your business, or in your investing? Like, what would you say I've helped you with the most?
Yeah, I mean, I had the big picture pretty solidly laid out. It was just the execution of such. So, where to go find the research, how to do the research, how to read these companies' reports, look at where are strategic places in the world to invest, strategic style companies, and what type of exit opportunities are available with these types of things. So that has been, really good for me. It's been able to, I'm always looking at how do I become extremely efficient. And one of the ways is to compress the time for learning. And this is one of the ways I do it. That's why I love joining masterminds. I'm, in all sorts of masterminds, be it business or self-storage specific or real estate. And this is just another one of those buckets that I wanted to get into and learn more about at a higher level.
That's great, man. I really appreciate the kind words that you said to me.
Yeah.
We're both in Raise Masters as well, which is a high level raising equity and raising money mastermind.
That's
and
right.
So, man, like compared to the masterminds that you've paid for, do you think that you got value for money with me? I mean, you've been with me for at least a year now.
Yeah, absolutely. That's kind of what we're always looking at, is how do we get, we set aside a certain percentage of our revenue each year to spend only on things that are education focused that will get us kind of to the next level. And so this was a natural fit for some of those funds.
Sounds great, man. So tell everybody that's watching, how do they get in touch with you? And so if somebody's watching and they want to get in touch, share how they would get in touch with you.
Yeah, so there's two easy ways to do it. The first one is just to go to our website. So as you can see behind me, it's SSSE.com. So Sierra Echo.com. There's a bunch of tabs there, depending on if you want to be an investor, if you want to buy self-storage, if you want to learn about it, it's all there. Another way that's really easy to connect with us is to check out our social media across all platforms. So you can either check out Self-Storage Syndicated Equities or Triple SE, SSSE, or if you want to connect with me specifically, all of my handles are The Storage Stud. So that's across all the platforms, Twitter, Instagram, Facebook, LinkedIn, all of the big ones out there. We're on it, and we're putting out a lot of really good content for free about our industry and how to get involved. We're usually posting 3 to 5 times a day.
That's wonderful, man. So Chris, your final word, what would you say to somebody that's on the fence and thinking about working with me and you and the group?
I'd say just give you a call and just talk to you. I know the first time I was kind of on the fence, I just called you, and I think we talked for almost 2 hours, and that was really enlightening for me. So that's what I'd recommend people do.
Fantastic. I know you got to run now, brother, but thank you so much. And we'll definitely do a part 2 to this interview, because I know me and you could talk for hours. So
that's right.
But thanks again, Fernando, for joining us. Really appreciate it. And I hope you enjoy your time in Mexico. Thanks again, man. Just for everybody that's watching, like my channel, subscribe. Leave comments below if you have a question or a comment about this interview. To get in touch with me, my website, andrewmcdaniels.com. I'm on Twitter @AndrewMcDaniels. I'm on Instagram @Mining Investing Education, @Mining Investing Education. And I've got several YouTube channels, and reach out to me on Facebook. Thank you. That's basically it, man. Thank you so much. Enjoy the rest of your evening. Take care.
You too. Thanks, Andrew.